Stop right now and look at this screen. Picture waking up to see tens of billions wiped out overnight. That is exactly what just happened to silver. Late January 2026, the paper market rocketed to around $122 an ounce. Then, in a matter of days, it collapsed to the low $70s. More than 40% of value erased in under 72 hours, one of the most violent drops in decades. But here is what makes no sense at all. Normally, a crash like that means too much supply everywhere. Yet right now, physical silver is disappearing faster than anyone can source it. Dealers are rationing, mints are delaying or stopping shipments. Online retailers are limiting orders or going out of stock completely. This is not a normal correction. This feels like a deliberate illusion designed to force people to sell before the real move upward begins. The paper price is screaming panic. The physical market is quietly saying something completely different. Why would the most powerful nation on Earth suddenly convene an emergency summit on critical minerals just days after this kind of destruction? What do they see that the public does not? And here is the detail that really stopped me cold. While Western exchanges were in total meltdown, while headlines declared precious metals dead, buyers on the other side of the world were quietly paying a huge premium, over 25% above the crashed Western price for the exact same physical metal. They were not dumping, they were accumulating calmly, methodically, while everyone else was running. By the end of this video, you will understand exactly who was buying when the West was selling, and you will see three major signals the mainstream completely missed. These three facts tell a very different story from what you have been told. Welcome to the channel that looks behind the curtain, at moves the big media ignores. If this kind of analysis matters to you, hit subscribe now, because what we are about to unpack is not appearing on cable news. And if this connects for you, drop a like so more people see it. Let us dive in. First, I need to set the context quickly. Silver climbed from roughly $30 in early 2025 to $122 by late January 2026, a 300% plus gain in just over a year. Gold reached all-time records above $5,500. The rally was driven by central bank accumulation, weakening dollar confidence, and explosive industrial usage. But in the last few weeks, the character changed dramatically. Retail momentum traders, speculative funds, and high-speed algorithms all piled in at once. Silver jumped over 50% in January alone. Every night, Asian buying pushed prices higher. Every morning, Western traders woke up to gaps they could not catch. Then the reversal came hard and fast. A more hawkish Fed nominee was announced. The dollar suddenly strengthened. That combination lit the fuse. The selling began in Asia first. The same participants who had fueled the rally flipped to profit-taking. Once the cascade started, it fed on itself. Margin calls forced liquidations. Liquidations triggered more margin calls. Algorithms sold into algorithms. Humans could not react fast enough. By the time major Western markets opened, the damage was catastrophic. Silver fell 37% in a single session, the worst day in over 45 years. Traders described it as pure carnage, but Friday was only the beginning. Over the weekend, the exchange dramatically increased margin requirements on silver futures. For anyone leveraged, it was like being told to double your deposit immediately or lose everything. Thousands of positions were forced closed, prices fell further. More calls were triggered. The spiral accelerated. By early the next week, silver touched the low $70s, down 41% from peak. Gold dropped over 20% from its high. Everything correlated. Equities, crypto, commodities, all bled. This is where most coverage stops. They show the chart, explain the margin hike, say be careful, and move on. But we are going deeper because three major signals changed the entire picture. The first one genuinely shocked me when I saw the numbers. While the West panicked and sold at fire sale prices, the physical market in the East was doing the opposite. The Shanghai spot price for physical silver was trading at a massive premium, around 27 to 30% higher than the crashed Western benchmark. The same metal, to completely different valuations. The market everyone thought was panicking was actually willing to pay significantly more. That is not retail buying. That is strategic, deliberate accumulation. The second signal most people missed. On the Shanghai Futures Exchange, multiple silver contracts hit daily limit down. Trading halted. But when you convert those limit down prices to dollars, Their absolute worst-case floor was still $12-18 higher than where Western futures were freely trading. Their crash floor was our ceiling. And they did not just sit there. They intervened aggressively, suspending several large funds from trading, imposing strict position limits, barring certain traders from new positions for weeks. They were trying to prevent overheating on the way up, not on the way down. Yet even after all that intervention, silver found support quickly and bounced sharply off the lows. That is not the behavior of a dying asset. The third piece ties it together. One of the largest Western banks, a dominant force in precious metals, trading for decades recently, shifted a major part of its precious metals operation to Asia, not expanding in New York or London. They moved people, systems, and strategic focus to the region, where physical demand is surging, where central banks are building reserves, where premiums are the highest. Institutions do not make moves like that lightly. They do it because their internal analysis shows the center of gravity for these metals has permanently shifted. Now put these three together. Eastern physical buyers paying large premiums while the West crashes. Eastern exchange floors still well above Western prices even at limit down. A major Western institution repositioning toward Asia. And then add one more piece. This Wednesday, the United States is hosting an emergency ministerial level meeting focused on critical minerals, supply chains. Delegations from multiple countries are attending. The stated goal: strengthen and diversify sources of minerals vital to national security and technology. When governments use words like strengthen and diversify, they usually mean one thing: we have a vulnerability and we need to fix it fast. Silver sits at the heart of that list. It is not mainly jewelry or investment coins. Silver is consumed in huge quantities by the modern economy. Solar panels require it in every cell. Electric vehicles use it in batteries and electronics. 5G infrastructure depends on it. Semiconductors, advanced defense systems, medical devices, smartphones all rely on silver. Last year, industrial demand alone consumed over 650 million ounces, more than half of total global usage. And the world has run a persistent supply deficit for years. Stockpiles are being drawn down. New primary silver mines take 8 to 12 years to bring online. Most silver is a byproduct of copper and zinc mining, so even high prices do not quickly increase output. That structural mismatch is why governments are suddenly paying attention. Possible outcomes from Wednesday's meeting include strategic stockpiling programs, new trade agreements to secure supply, incentives for domestic production, restrictions on foreign purchases. These are not small moves. They are exactly what nations do when they realize a resource is too important to leave to open markets. China has already taken similar steps with other critical materials. Now it looks like the United States is starting to respond. Here is the timeline in plain language. Silver and gold hit all-time highs late January, massive euphoria. Then rapid reversal, hawkish Fed signals, stronger dollar. Selling cascade begins in Asia, feeds on margin calls, historic single-day drop. Weekend margin hike accelerates forced selling. Silver touches low $70s, then sharp bounce minus 18% recovery in days. Eastern physical buyers pay large premium throughout. Their futures floor stays well above Western levels. Major bank repositions trading desks to Asia. United States convenes Emergency Critical Minerals Summit. That is not random. Now let me bring in a respected voice for perspective. Ray Dalio, one of the most successful macro investors alive, has explained that true bear markets in assets often require sustained liquidity drain. Not just one shock event, rate hikes, quantitative tightening, months of cash leaving the system. That is what kills bull markets long term. Right now, the Fed is not doing that aggressively. Even with a more hawkish chair nominee, the market still expects eventual rate cuts. The liquidity drain Dalio describes has not fully arrived. So the violent reaction may have been more about leverage and froth being cleared out than the fundamental story breaking. The 1970s offered the clearest parallel. Gold ran from $40 to over $200. Euphoria was everywhere. Then it crashed over 50%. Headlines declared the bull market dead. Many retail buyers sold at the bottom in fear. Then gold eventually went to $850, a massive move for those who held through the shakeout. The crash did not kill the trend, it killed the tourists. The same thing may have just happened here. Silver ran from $30 to $122. crashed 41% to low $70s, bounced hard to mid-$80s. Gold dropped 20% plus, then recovered strongly. That is not the pattern of a dead asset. Real buyers stepped in at the lows. Industrial users cannot stop solar. EVs, electronics, all need silver, regardless of price. Some large consumers are reportedly securing direct mine supply, bypassing exchanges entirely. That kind of behavior shows deep concern about future availability. So here is what I am watching closely this week. The official readout from Wednesday's Critical Minerals meeting, any mention of stockpiling, new alliances, or silver specifically. Any executive action in the days after, the Shanghai premium, if it stays elevated, it confirms physical reality is not following paper. And of course, the price action itself. If silver holds above the recent lows and continues recovering while the premium remains high, that tells us the divorce between paper and physical is real and likely permanent. Before I give you my honest opinion, let me ask you for questions. If this was only a normal correction, why are Eastern physical buyers paying 25 to 30% more than the West? If demand truly collapsed, why did China suspend funds and tighten rules to prevent excessive buying, not selling? If precious metals are irrelevant now, why is one of the largest Western banks shifting its entire precious metals operation toward Asia? And if none of this matters, why is the United States suddenly holding an emergency government-to-government meeting on critical minerals supply right after the crash? Nobody in mainstream media has answered these convincingly. So here is my personal view, not advice, just what the data keeps showing me. I believe we just watched the moment the paper silver market and the physical silver market officially separated. They used to move roughly together. Now they are pricing two different things. Western paper, silver, driven by leverage, futures, margin calls, crashed 41%. Physical silver, the actual atoms needed for solar panels, missiles, 5G, EVs, barely blinked. Eastern buyers kept paying well over $100 equivalent, while the West sold at $72. That is not a temporary dislocation, that is a structural break. Wealth did not vanish in the crash, it transferred. From panicked retail and leveraged traders to patient strategic accumulators. From people reacting to red screens to people acting on supply-demand reality. That is why these crashes happen. The weak hands get shaken out. The strong hands quietly load up. I think the paper market may remain volatile and disconnected for a long time. But the physical market, the one that actually matters for technology and national security, is quietly telling a very different story. That is my read. I could be wrong. Markets are brutal teachers. But when the Shanghai premium stays massive, when governments convene emergency meetings, when major banks reposition to Asia, it is very hard to ignore. Drop your thoughts in the comments. Do you think this is just another correction? Or do you see the same signals I see, the beginning of a bigger shift? I read every comment. The best insights often come from you. If this opened your eyes to something new, share it with someone who needs to see it. And if you are not subscribed yet, hit that button. We are going to keep following this story as it unfolds. This is The Hidden Economy. I will see you in the next one.